Hey everybody, good afternoon, good evening, depending on when this finds you. Tonight's Halloween night. We're bringing an end to October, going to kick off November trade starting tomorrow, and this will be the free video to begin the month of November. So I pulled the expected move as priced into the options chain for the week this week and expecting it to be rather foretelling of some volatility this week, given the fact that we've got a few things on the agenda. There are 4 central bank meets and decisions, all rate decisions actually, this week, from the RBA, BOJ, our Fed, the FOMC, and the BOE, all this week. So I'm looking for, there are a couple of things I want to get to in the premium videos with regard to, some yen and euro trade and that kind of thing. But for this venue, let's look at the week as a whole, and I'm starting with the S&P here, giving you the idea that we're looking at about 30 plus or minus, but approximately 30 points in volatility this week, as is expected and priced into, like I said, the options chain. It could go either way. You say 30 plus or 30 minus. The answer is yes. It's plus or minus. And when would we look for this to kick off? I am expecting to see this volatility kick off tomorrow or Wednesday. Likely, I'm thinking Wednesday. But if you look at which of the days of the week show the higher probability for volatility, it's actually Tuesday. So I say tomorrow or Wednesday. I'm really thinking Wednesday on the Fed, on the FOMC. So that means, given the fact that here we are at a 2120 trade, 30 lower would put us down at about 2090, and I've been looking for this 2080-ish. We'll call it 2085 or so, something like that print, for a couple of reasons. And that is that if you, here we're looking at a daily chart, if you come back here to the low before this move, it was about a 1980 low by a 2180 high. That's 200 points. So a correction of a half back from that move would bring us back to about a 2080, 2085, something like that. But additionally, on a $2,000 index, for us to correct 100 points would be a 5% correction for the overall market, which would be a buying opportunity by many. It would be viewed, I believe, as a buying opportunity by many money managers, that kind of thing. They would see it as an opportunity to buy into a nice, healthy, they say 3 to 5% correction. This would be about a 5% correction. So, of course, there is also the possibility that the market just takes off from here and does not show those lows, and that's completely fine. In that case, you'd mark up the current prints by about 30 points and get a 2150 to actually the number up here. To be honest with you, the real balance up here in this area. I'm trying to think of another way to describe it, but that's the profiling terminology. But the attractive price or the balance up here in this area is about 2153 if if we are to target the upside. And in fact, that will be the target on the upside, regardless of whether or not we see the break first down into the 2080, call it 2085 area. All right. So here's where I'm at overall. If this first on this volatility this week, and I am anticipating some, as are the market makers. I mean, I'm looking at the options chain and seeing what's priced in. If indeed we are to see the volatility first provide us with a correction, then we'll look into this area of approximately 2080. If you want to mark it up a couple of points, if you're not worried about a couple of points, you can call it 2085, something like that. That's in line with the expected move. At that point, And in that area, I would, especially first time in, I would look for responsive buying to bid us back out of the hole for this market to correct, as it has every time since the March '09 lows. I mean, every time the market breaks, this has been a pretty resilient market. I mean, every time it breaks, the buyers respond with the bid that then corrects and bids the market back higher, and we end up going out for the move on the highs. So pretty impressive. Alternatively, and by the way, the target for that would be up in the 2035, right up in this area, is a very, very attractive area. You can see it if you look through here. You can see where the middle of all that trade is, approximately 2135. But the problem is we don't know that we're going to get that correction. So there's one plan, or one possibility, and that is that we see the break. And if we see the break, the expected move would have us into this area, and with that, I would anticipate seeing responsive buying that bids us, back out of the hole. Alternatively, what can happen, of course, is this thing can just take off from current levels. This 2117 area that we've got marked here is a pretty important price, and essentially we broke actually down into that level earlier today and rejected it kind of nicely. Not terribly impressive, but kind of nicely. So alternatively, we may just find ourselves bid right out of the hole here. Well, the expected move would have us about 30 higher from the current levels, which is actually, I can tell you where the balance is up here. It's right in the middle of this trade, and that print is 2153. So if in the event there is just a straight shot out of the hole, you're going to be targeting the 2153 area right up in there. So you may be left with this question of, well, how can I tell then, right? Because I gave you two alternatives. One, you break for lower and buy it at about 2080, 2085, and we bid out of the hole. Or two, we just straight moonshot from current levels to a 2153 target area. So what's the line in the sand? What's the level that delineates the one scenario from the other? And I believe that is about a 2140 to 2141 trade. 2140-41 trade right in there. That to me is the level that we've seen the market bid into and reject numerous times, and it's just a level that is to be respected, observed and respected and remembered. And if we get a close above that 2140 level, then fine. We can start to target 2153, and if we can then target that level, I'll give you some more up here. I've already got them mapped out, but I'll save that for another video. However, we've seen, and we may very well see again, a bid into 2140 that's again rejected. And if that's the case, then you have to continue to observe the very distinct possibility that we're going to see this correction down into this half back from the 200-point bid, and it's synonymous with a 5% correction from the highs, given the fact that it's a $2,000 index. I hope that makes sense. I'm giving you the two scenarios with the line in the sand between the two, also with timing, and I would anticipate that volatility to really start to pick up on Wednesday with the Fed, although it could start as early as tomorrow. I did not look for much today. We did not get much today. I really anticipate seeing this starting on Wednesday. So, and the other thing too, at the end of the week, of course, please do not forget, please do remember that at the end of the week this week, we also have the non-farm payroll report, the jobs report with unemployment as well. And so there will be a lot of eyes on that report as well. So Wednesday on the Fed, Friday on the payrolls. Should prove to be a rather interesting week. We've started off slow. I do not anticipate the rest of the week being a mirror image of today's lackluster, trade and low volatility. I really don't, and look for it to start to pick up on Wednesday with one of these two scenarios. Hope this helps. Good trade, nice evening. See you again at the next update. Good night.